Friends, thank you for being here today. We live in an era of noise. Turn on the television and you are bombarded with ticker tapes, shouting pundits, and headlines designed to elicit an emotional reaction rather than an intellectual one. For those of us who have navigated the economic cycles of the last several decades, who remember the inflation of the 1970s, the exuberance of the 1990s, and the devastation of 2008, we know that the truth is rarely found in the noise. The truth is found in the silence. It is found in the footnotes of regulatory filings, in the obscure adjustments of balance sheets, and in the quiet movements of the smart money before the storm arrives. Today, we are going to tune out the noise and focus entirely on the signal. We are going to discuss a shift that has occurred quietly, almost imperceptibly, within the walls of the most powerful financial institution in the United States, JPMorgan Chase. Over the last few weeks, this institution has made a move that sends a more dangerous signal than anything we witnessed leading up to the 2008 financial crisis. Most people didn't notice. There was no press conference. There was no public announcement from CEO Jamie Dimon. There was simply a quiet repositioning of a balance sheet worth $456 trillion. To the untrained eye, business continues as usual. But for those who know where to look, JP Morgan has just sounded the loudest alarm bell in modern banking history. The question we must answer today is not whether you will be affected, because in a globally connected economy, we are all affected, but whether you will understand what is happening before the impact reaches your front door. Whether you are managing a retirement portfolio, protecting a lifetime of savings, or simply trying to understand the economic ground shifting beneath your feet, this analysis is for you. This is not about Wall Street traders. This is about the invisible foundation of your financial life. That foundation has shifted. To understand the gravity of the current moment, we must first examine the silent alarm ringing from the bank's fortress balance sheet. We must contextualize the entity we are discussing. JPMorgan Chase is not merely a bank. It is the financial backbone of the United States. It is the institution that regulators call when the system is breaking. They are the bank that swooped in to buy Bear Stearns in 2008 when the investment banking world began to collapse. They are the ones who absorbed Washington Mutual. They are the ones who grabbed First Republic in 2023 when regional banks started failing. JP Morgan does not react to crises. JP Morgan anticipates them. They position themselves to survive the storm and then acquire the wreckage for pennies on the dollar. Therefore, when JP Morgan changes its stance, it is not a suggestion, it is a forecast. This forecast begins with a massive $4.56 trillion repositioning. On January 13, 2026, JPMorgan Chase reported its fourth quarter earnings for 2025. The headlines were deceptively optimistic. Net income of $13 billion sounds healthy. Record payments revenue of $5.1 billion suggests a robust economy. Record asset and wealth management revenue of $6.5 billion implies that the rich are getting richer. However, buried deep within the details of the financial statements was a stark reality that contradicts the headline optimism. The bank established a $2.22 billion credit reserve specifically for forward purchase commitment. Let us pause and analyze what this means. In plain English, a credit reserve is money set aside to cover loans that the bank expects will not be paid back. When a bank establishes a reserve of this magnitude, $2.2 billion, they are effectively taking money out of their profits today because they are mathematically certain they will lose money tomorrow. They are not being cautious. They are preparing for deterioration. This move alone caused the bank's advanced Basel III Common Equity Tier 1 capital ratio to drop by 90 basis points, nearly a full percentage point. For a bank of this size, to voluntarily take a hit to its capital ratio to build a defensive wall is a significant indicator of internal concern. But the smoking gun is found in the loan-to-deposit ratio. The most telling metric is not the reserve itself, but the broader structure of their balance sheet. As of September 30th, 2025, JP Morgan's total assets stood at $4.56 trillion. Here is the breakdown that exposes the strategy. While deposits stand at a massive $2,548 trillion, loans are significantly lower at only $1.67 trillion. This discrepancy matters immensely. In a healthy, growing economy, banks take in deposits and lend them out. That is the fundamental business model of banking. Pay a depositor 2%, lend to a borrower at 6%, and pocket the difference. However, JP Morgan is currently holding significantly more in liquid assets than they are deploying as loans. They are sitting on $411 trillion in cash and short-term marketable securities. This is what we call a fortress balance sheet. It is the financial equivalent of pulling up the drawbridge, stocking the pantry, and arming the guards. You do not hoard $1.4 trillion in cash if you believe the economy is about to boom. You do not hold that much liquidity if you see creditworthy borrowers lining up for loans. You hold that cash when you expect that opportunities to lend safely are disappearing and that the liquidity will be needed to survive a drought. When the largest bank in the United States decides to hold cash rather than lend it, they are effectively shorting the American economy. They are betting that the return on safety is higher than the return on risk. And when JPMorgan stops lending, the gears of the economy begin to grind to a halt. This brings us to a historical parallel, the ghost of 2006. For those of us in the baby boomer generation, the feelings of 2008 are still fresh. We remember the shock of seeing Lehman Brothers collapse. We remember the confusion as retirement accounts evaporated. But what we often forget is the period immediately preceding the crash, the year 2006. It is crucial to understand that financial collapses do not happen overnight. They are processes, not events. And the process we are witnessing today mirrors the setup of 2006 with terrifying precision. Back then, we lived under an illusion of stability. In 2006, the economy looked superficially stable. Housing prices had peaked but had not yet crashed violently. Unemployment was low, the stock market was performing well, banks were reporting strong earnings. If you listened to the news, everything was fine. But if you looked at the bank balance sheets, a different story was being written. In 2006, banks began quietly repositioning. Citigroup's off-balance sheet assets reached $2.1 trillion, actually exceeding their on-balance sheet assets. They were moving risk out of sight. They were tightening credit standards internally while maintaining a public face of optimism. Research analyzing insider trading from that era reveals a damning truth. Top executives at the banks that eventually suffered the biggest losses in 2008 were aggressively selling their own shares in 2006. They sold before the crisis started. They sold before the public knew about the toxic mortgage-backed securities. They sold because they saw the internal data. They saw the loan applications getting weaker. They saw the payment delays ticking up. They knew. And they positioned themselves accordingly while the public remained in the dark. Now we must distinguish between the signal and the noise. Today, we are seeing the exact same divergence between public narrative and private action. JPMorgan's public narrative is one of strength and resilience. Their private action, hoarding $1.4 trillion in cash and building massive loss reserves, is a defensive crouch. They are not preparing for a soft landing. They are preparing for a hard contraction. The $2.2 billion credit reserve is not for routine credit card defaults. It is a buffer against systemic stress when the most sophisticated bank in the world, with the best data and the deepest political connections, chooses safety over profit. They are seeing credit quality deterioration that has not yet shown up in the official government statistics. Government statistics are lagging indicators. They tell us what happened 6 months ago. Bank balance sheets are leading indicators. They tell us what is going to happen 6 months from now. JPMorgan is betting on a future that looks very different from the present. I want to pause here and ask those of you who were managing your own finances back in 2006 and 2007. Do you recall sensing that something was wrong before the official news broke? Or did the crash of 2008 take you by surprise? Please share your memories in the comments. Your historical perspective is a valuable lesson for the younger generation watching this. If we look closely, we can identify 4 specific pillars of the coming crisis. If JPMorgan is preparing for a storm, we must ask, what does the storm look like? Based on the data embedded in their filings and the broader economic context, we can identify 4 specific pillars of the crisis they see approaching. The first major pillar of this crisis is the consumer debt trap. The American economy is driven by consumption. Consumer spending makes up roughly 70% of GDP. Therefore, the health of the consumer is the health of the economy. Right now, the consumer is on life support. In the third quarter of 2025, consumer credit card debt in the United States hit an all-time record of $1,023 trillion, but the raw number is less terrifying than the cost of that debt. The average interest rate on those credit cards stands at 21.39%, also the highest level ever recorded. Consider the mathematics of this. We have an aging population and a younger generation struggling with cost of living increases. When you combine record debt levels with record interest rates, you create a mathematical impossibility. The debt service costs, the money required just to pay the interest, are consuming a larger and larger percentage of household income. JPMorgan sees this data first. With 80 million customers and the largest credit card portfolio in the nation, they process millions of transactions every single day. They see when you switch from buying name brand groceries to generic. They see when you make the minimum payment on your credit card instead of paying the full balance. They see when the payments stop altogether. They are seeing delinquencies rise. Not catastrophically yet, but the trend line is unmistakable. The American consumer is tapped out, and when the consumer stops spending, the recession begins. I am interested to hear your on-the-ground perspective on this. The official statistics often say inflation is under control, but what are you seeing at the grocery store or the gas pump in your city? Are the prices you pay matching the government's narrative, or are you seeing a different reality? Let us know below. The second pillar of risk is the slow-motion train wreck in commercial real estate. This is a crisis that has been developing since 2020, but the bill is now coming due, specifically in the urban office market. Office vacancy rates remain stubbornly high. Property values in major metropolitan areas have declined significantly. Yet banks are holding massive exposure to loans against these properties. In the fourth quarter of 2025, JPMorgan increased their provision for credit losses to $466 billion. While they attributed some of this to their acquisition of the Apple credit card portfolio, a significant portion reflects what they are seeing in commercial lending. Commercial real estate relies on refinancing. A building owner takes a loan for 5 years. When that loan matures, they must refinance it. But today, the building is worth 30% less than it was 5 years ago, and the interest rate on the new loan is double what it was. The math doesn't work. The borrower hands the keys back to the bank. JPMorgan knows that hundreds of billions of dollars in commercial real estate loans are set to mature in 2026 and 2027. They are reserving cash now because they know those defaults are inevitable. There's a third, more insidious element involving a whistleblower and a netting scandal. The story emerged in January 2025. A former JPMorgan banker blew the whistle, alleging that the firm had been understating the risk it posed to the financial system. The allegation centers on a practice called netting. Netting is a complex accounting technique where a bank offsets its liabilities against its assets to report a smaller overall exposure number. The whistleblower claimed JPMorgan was using this practice, prohibited under certain Fed rules and international standards, to make the bank appear less complex than it actually is. Why does this matter to you? Because by appearing less complex, the bank is allowed to hold less capital in reserve than regulations would otherwise require. The whistleblower estimated this allowed JPMorgan to issue an additional $75 billion to $100 billion in loans that should not have been approved if the risk had been measured correctly. If these allegations are true, it implies that the entire banking system is more leveraged than the official numbers suggest. It means the buffer protecting the economy from a crash is thinner than we thought. If capital buffers are thinner and risk is higher, the margin for error is zero. Finally, we must look at the Federal Reserve's quiet panic regarding the plumbing of the system. In December 2025, the Federal Reserve quietly removed the aggregate operational limit on its standing overnight repo operations. To the layperson, this sounds like bureaucratic gibberish. To a financial analyst, it is a flashing red light. The repo market is where banks lend money to each other overnight to ensure they have enough cash to operate. When the Fed removes the limits on its own repo facility, it is saying, "We will lend you unlimited amounts of cash if you cannot get it from anywhere else. You do not remove speed limits unless you expect to drive an ambulance. You do not remove liquidity limits unless you expect a liquidity freeze." The Fed is signaling that they see stress in the interbank lending market, the same kind of stress that froze the system in 2008. They are prepositioning the fire hoses because they smell smoke. Now, we need to understand how this slow bleed hits Main Street. We have discussed billions of dollars and trillions in assets. But what does this actually mean for your life? What does it look like when the banking system tightens? It is vital to understand that this crisis will likely not begin with an explosion. It will not be a sudden shuttering of ATMs or a bank holiday where you cannot access your cash. Instead, it will be a slow bleed. It is a suffocation of the economy through the restriction of credit. It starts with the mechanics of credit tightening. When JPMorgan hoards cash, they are, by definition, not lending it. Because JPMorgan is the dominant player, their behavior sets the tone for the entire industry. When they pull back, everyone pulls back. This manifests in subtle, frustrating ways. You might first experience this when you try to refinance your home to lower payments or access equity. Despite having a good credit score, you find yourself denied because the bank has tightened its debt-to-income requirements. It continues when a local business owner, perhaps your favorite restaurant or local contractor, needs a working capital loan to bridge a gap in cash flow. The bank says no, and the business, despite being profitable, runs out of cash and closes. Even small conveniences disappear, such as when you request a credit limit increase to handle a medical emergency or a home repair, only to have the request denied. None of these events make the evening news. They feel like individual failures. But when they happen to millions of people and businesses simultaneously, they strangle the economy. This tightening creates a negative wealth effect that hits asset prices directly. This is of particular concern to retirees holding stocks or real estate. Financial assets are priced based on liquidity and growth expectations. When credit is easy, businesses expand, earnings grow, and stock prices rise. When credit tightens, businesses contract, earnings disappoint, and stock prices fall. Furthermore, we are currently in an environment where government debt is at $38.4 trillion and corporate debt is at record levels. The entire system is leveraged. When you tighten credit in an over-leveraged economy, the adjustment is violent. Real estate prices, which are heavily dependent on the availability of mortgages, will face downward pressure. Stock market valuations, which are currently stretched, will face a multiple compression. meaning investors will be willing to pay less for every dollar of earnings. This is the wealth effect in reverse. As home values and stock portfolios stagnate or decline, people feel poorer. When they feel poorer, they spend less. When they spend less, corporate earnings drop further. It is a self-reinforcing downward spiral. We must also confront a specific danger that threatens the retirement plans of millions, the trap of traditional wisdom. We must pause here to address a painful reality that specifically targets the generation represented here today. The failure of the set it and forget it financial strategy in a regime of credit contraction. For 40 years, since the early 1980s, the economic playbook has been relatively simple. Interest rates generally trended downward, creating a massive tailwind for both stocks and bonds. This environment birthed the 60-40 portfolio and the rise of passive index investing. The wisdom was clear. Buy the market, hold it, and you'll be fine. But JPMorgan's shift signals the end of that era. By hoarding $1.4 trillion in cash, they are explicitly rejecting the safety of standard government bonds and the growth potential of the broad stock market in the short term. If the smartest bankers in the room are refusing to buy and hold right now, why are you still fully invested in a passive index fund? Here is the mechanism that most retail investors miss. Passive investing, buying ETFs that track the S&P 500 or the total bond market, works beautifully in a bull market. It is efficient and low cost. But in a credit crisis, these vehicles become traps. Passive funds are dumb money by design. They must buy every company in the index, regardless of whether that company is a profitable fortress or a debt-ridden zombie. JPMorgan knows that as interest rates stay high and credit tightens, the zombie companies, firms that have only survived this long because of cheap debt, will face bankruptcy. If you own the index, you own the zombies. You are effectively subsidizing the failure of bad businesses with your retirement savings. Furthermore, we must discuss the issue of liquidity. In a severe downturn, correlation goes to 1. This means that assets that are supposed to balance each other out, stocks and bonds, can fall simultaneously. We saw this in 2022, and JPMorgan's positioning suggests they fear a repeat. When they build a fortress balance sheet, they are moving away from the open field of the public markets, because they know that when the exit doors are small and the crowd is large, not everyone gets out. The bank is engaging in active management. They are discriminating between good risk and bad risk. They are selling what is vulnerable and hoarding cash to buy what is valuable later. In contrast, the average 401k or pension fund is fully exposed to the bad risk. This mismatch between institutional positioning and retail positioning is where wealth is transferred. The institutions sell before the trouble becomes obvious. The retail investor is left holding the bag after the trouble hits the headlines. This does not mean you should panic sell. It means you must realize that the rules that govern the last 40 years of investing may not govern the next 4. The passive trap is the assumption that the future will look exactly like the past. JPMorgan has just bet $4.5 trillion that it won't. This brings me to a question for you. Do you still have confidence in the traditional 60-40 portfolio model? Or have you begun to shift towards cash and tangible assets like JPMorgan has? It is a difficult decision to make, and I would value hearing how you are approaching it in the comments. In light of this, we must discuss your strategic defense and what you must do. We are not discussing this to induce panic. Panic is a distinct lack of a plan. We are discussing this to induce preparation. History rewards the prepared and punishes the oblivious. If JPMorgan, the most informed financial institution on the planet, is moving to a defensive footing, it is only logical that we should consider doing the same with our personal finances. First and foremost, you must reduce leverage. The first rule of a credit contraction is that debt becomes dangerous. In a boom, debt is a tool to amplify returns. In a bust, debt is an anchor that drags you under. If you're carrying variable rate debt, credit cards, HELOCs, or adjustable rate mortgages, priority number 1 is to pay it down. Do not assume that you will be able to refinance later. Do not assume that your credit limit will remain open. Banks can and will close lines of credit without warning when they are reducing risk. Secondly, you must prioritize liquidity. JPMorgan is holding $1.4 trillion in cash. They are prioritizing liquidity over yield. You should consider why. In a crisis, cash is king not because it earns a high return, but because it buys you options. When asset prices fall, the person with cash is the person who can buy quality assets at a discount. The person without cash is forced to sell assets at the bottom to survive. For retirees, this means ensuring you have a sufficient cash buffer, money that is not exposed to the volatility of the stock market, to cover 12 to 24 months of living expenses. This prevents you from having to sell stocks in a down market to pay for groceries. Third, focus your portfolio on real value. In a credit contraction, financial engineering fails, but fundamental value survives. Real assets are those that generate cash flow regardless of what the stock market does. This includes income-producing real estate because people always need a place to live. and essential businesses that provide goods people buy even in a recession, such as healthcare, consumer staples, and utilities. It also includes treasury bills, where short-term government debt is currently offering a yield that, while not exciting, is safe. Conversely, you must avoid speculative assets. Avoid companies that do not make a profit and rely on constant borrowing to survive. Those are the zombies that will be purged when the credit window closes. And finally, you must adjust your expectations for the decade ahead. We have lived through a decade of artificial asset inflation driven by low interest rates. We must accept that the next decade may look different. Returns may be lower, growth may be slower. The goal now is not aggressive expansion of wealth, but the preservation of it. As we conclude, we must address the most fragile element of all, the crisis of confidence. Modern banking is a confidence game. It relies on the shared belief that deposits are safe, that loans will be repaid, and that the institution is sound. When confidence erodes, the system can unravel with shocking speed. We saw this in March 2023 with Silicon Valley Bank. It was not a slow decline, it was a sudden collapse. Depositors lost confidence and withdrew $42 billion in a single day. In the digital age, a bank run does not happen with people standing in line around the block. It happens with the click of a mouse. JPMorgan's defensive positioning suggests they are preparing for a period where confidence becomes scarce. They are building a fortress so that when the panic comes, when depositors are looking for a safe harbor, JPMorgan will be the only ship that looks unsinkable. They are preparing to be the last man standing. Now, you might be asking about the timeline. Does this mean the collapse happens in 2026? Not necessarily. Systemic crises do not run on a schedule. This positioning could be for late 2026, 2027, or even 2028. The stress builds slowly, like pressure in a fault line, until a trigger event causes the earthquake. That trigger could be a geopolitical shock, a major corporate bankruptcy, or a sovereign debt issue. The trigger is unknowable, but the pressure, the debt, the delinquencies, the leverage, is measurable, and JPMorgan is measuring it. So, where does this leave us? Friends, the secret move is not really a secret. It is disclosed in regulatory filings. It is visible in the balance sheet data. But it is secret in the sense that the vast majority of the public is distracted by the noise and is not looking at the signal. JPMorgan Chase has looked at the American economy and decided to pull back. They have looked at the creditworthiness of the American consumer and decided to build reserves. They have looked at the stability of the financial system and decided to hoard cash. They are not panicking. They are calculating. They are making a rational decision based on data that says the risk of lending money today outweighs the reward. If the most powerful bank in the world is tightening its belt, building a cash reserve, and preparing for a storm, it would be wise for us to do the same. The warning is not on the evening news. It is not in the press releases. It is in the numbers. And right now, the numbers are screaming caution to anyone willing to listen. If you found this analysis helpful in cutting through the noise, please consider sharing this video with a friend who needs to prepare. And tell me in the comments, what is the one single step you're taking today to build your own fortress? Thank you for your time, and may you navigate the waters ahead with wisdom and prudence.